Hello, this is Melissa, your insurance exam queen, and we are here on this channel to help make sure you can pass your insurance exam with ease and confidence.
This is another big one. This whole life and term, most of your policy questions are on these three policies. So universal life is under the topic of flexible premium policy. All that means is you can change your payment. Premium is what we pay, right?
Mm-hmm.
If it's flexible, I can change it. Now I'm going to use my little chalkboard because I'm not smart enough to make this into a PowerPoint. So I had to do this by hand. The way a universal life works, okay? Picture a bucket. That's a bucket, okay? And you put your money into the bucket.
Mm-hmm.
That's what we do with a universal life. My premium goes into a bucket. Now the insurance company pays you interest on that bucket. So right now it looks a lot like a bank account, doesn't it?
Mm-hmm.
Just put money in and they pay me interest. Cool deal. I don't have any insurance, Peter. Yeah, you don't. We have to do something about that. So what we do is we make a hole in the bucket on the side, and every month the insurance company goes into your bucket and they take out enough money to keep you insured. So now you have an insurance policy. Now, first thing I want to tell you, I'll go back to this picture, but I want to go on my slide because there's some things to understand about a universal life that it has none of the guarantees of whole life. Okay, remember whole life? We guarantee your rate, we guarantee your cash value. No matter what happens in the economy, that will happen, guaranteed by the insurance company. When we went to selling universal lives, we threw out guarantees. Why? See that interest rate? That's what they call current interest rate, meaning it will change.
Mm-hmm.
A year ago, it was like 1%. Today, it's like 3%. So it's going to depend on the economy. So guess what? If your interest rate is going to change over your life, I can't guarantee anything to you.
Right.
Don't know what your cash value is going to be. Okay. The other thing is, you see the hole in the bucket?
Yeah.
That's current, they take out what they call, I got a slide on that. First thing, cash value grows at current interest, which can be changed by the insurance company. Number two, the insurance charge, we call it the mortality charge, that can be changed by the insurance company. What they do is they go in and they take out, now you guys have been following me, so if I'm not making sense, they go in and take out 1-year term rates, which means the lowest amount possible to keep you insured. Well, that's a good deal for you, except every year that rate goes up, right?
Because of your age, yeah.
So the hole in the bucket gets bigger in time.
Uh-huh.
And they don't guarantee it because the mortality charge can be changed by the insurance company. They know what the death rate is now, and they'll give you that. But what happens if there were a plague and 20% of the population died from sickness? The mortality, the deaths go up. Insurance companies find they have to increase death charges. They're going to increase what they take out of your bucket, not just by age, but also by the rate, because the rate's not guaranteed. So the interest can change and the mortality can change. Now, I'm not trying, none of that's going to be asked of you. None of it, okay? The only reason I'm telling you this, I want you to understand this is different than a whole life, because different than a whole life, it's got movable parts. The whole life doesn't. The whole life is locked in, okay?
So this is neither term or perm. It's just
It is permanent. It is permanent.
It is.
It's not a whole life. It's a universal.
It's permanent, but it's not whole.
Correct. It's meant for you to keep till you die.
Okay.
Client deposits premium into a fund that pays current interest. The insurance company deducts the mortality charge from the fund. As long as there's money in the bucket to keep you insured, your policy is going to keep going and going and going. But one of the attractions of this policy is, oh, I got to tell you that. You probably haven't thought about this. Will you take a look at this bucket? In the early years, this person got a ton of cash value. They put in this money, they got interest, a little bit comes out of the bottom, the rest is cash value. In a whole life, you don't have any cash value for years and it grows. This one starts off with a lot of cash value. Okay, now in time, that's going to change and based on interest rate and what you pay in and everything. The insurance products are not designed to be a put and take account. That's a bank account. You put money in for Christmas presents. You don't put it into the insurance company. Insurance company money is meant to be paid out years from now. So the insurance company can't allow people to just put money in the policy and 6 months later go take it out to buy a car. So what they do is they put on something called a surrender charge. If you surrender your policy in the early years, they keep most of your money. If you ever bought a certificate of deposit at the bank, if you haven't, don't ride with me. But if you have, they guarantee you a higher interest rate, but you can't take it out until that time goes by, or they'll hit you with a surrender charge. It's a penalty for early withdrawal. So yes, the money's in there, but the policy is going to have to grow in age before you can get at it. Okay, but it's still cash value like a whole life. It just gets in there a different way. Now, people, this is a very popular policy because you believe it or not, you may be confused. This is easy for people to understand because every year they get a statement that shows what they put in, what the account's value is, how much was taken out for your insurance, and how much your gross cash value is, and then the net cash value is what they'll let you get at. And it shows you every month. And it doesn't take very long to figure out how this is working. But I want you to just get a sense why this is so much different than a whole life. In a whole life, you remember, you probably are too young to remember this. There was this guy who used to sell junk on the television called Ron Popeil. And he had this chicken roaster and he would say, set it and forget it. And he was always saying, set it and forget it. The whole life, set it and forget it, right? You put it in, you know what it's going to be. They guarantee it. You know what you got to pay, you pay it. This one is in the hands of the insured. You control how big your bucket is by how much you pay in. If you want to skip payments, you can, but you know, your bucket's not going to be as strong. So the insured is in charge of this policy. So they have more responsibility than you do in a whole life where the insurance company is going to guarantee it. But this is incredibly popular policy because life isn't constant. I start off, I can make payments, and then for a year, I can't make that payment. Okay. This is a perfect policy of that. As long as you got money in the bucket, you can skip payments, you can lower payments, and then make it up later. But I can't do that with a whole life.
Yeah, I can see why it's popular.
It's very flexible, it's very popular, and so it's sold more than whole life for all of those reasons. So universal life is the only policy that allows you to buy option A or option B, and this is on the test. It's not a whole life option, it's not a term option. It's only available on universal life. Now to explain this, okay? I gotta watch my time. I'm talking long times to you guys. I'm going to finish this even if I have to go over, but anyway, let me ask you a question and the answer will help you understand this. Let's imagine that Margie bought several years ago a whole life policy for $50,000. That's her face amount / death benefit. But over time, she's got this cash value that's growing to $30,000. Okay. And today's the day God calls her home. She's dead. How much is her family going to get? How much money is the insurance company going to pay that family?
The death benefit and the cash value.
No. She pays, they pay the death benefit.
Because it's not up to 100.
Well, what I'm going to tell you now is not on the test, but it's the big dark secret. The cash value is actually part of the death benefit.
Oh.
So it's just the part of the death benefit you can get at while you're alive. So if Margie had taken out a $30,000 loan to go buy a boat and she died, the insurance company is only paying her family 20.
Yeah.
But she already took some out. So at her death, her family gets 50,000. And then they scream, what happened to our cash value? It's part of your death check. Okay.
Yeah.
Now that's not on the test, but just got to understand death benefits, death benefit, cash values, living benefit. You don't get both unless you take option B on a universal life. Because if Margie had a universal life option B, her family would have received 80,000. They would have paid the death benefit plus the cash.
Right.
The only policy you can buy that on. We put it as an increasing death benefit because every year the death benefit increases by how much her cash value is. So you got the death benefit plus this increasing rider almost. It's like
Oh, thank you, Jesus. I'm getting it because I was going to say, is that considered a rider?
Well, they don't call it that, Ingrid, but between you and me and all the smart people, it is. Okay.
Very good.
But that won't be on the test. Here, the only thing they're going to ask you on the test, what they're asking test is very simple. Option A, it behaves just like a whole life. Level death benefit. When you die, you get the death benefit you bought. But if you buy option B, they'll pay the death benefit plus the cash. Now, to tell the whole story, as you would appreciate, that isn't free. The insurance company is just going to say, because you said B, we're just going to give you more money. You have to pay for that increasing benefit. And where you pay for it is, they take more out of your bucket.
Right.
Because you got more insurance now. Okay. That's not on a test. All of it's not on the test. The only thing that's on the test is universal life. You can buy option A or option B. That's on no other policy. And the only policy that we sell that will pay the death benefit plus the cash is option B, universal. Okay. So the biggest reason people buy it, however, is allows you to change your payments. As long as you keep that bucket with enough cash in it to pay your insurance, you'll be okay. But the day comes when they go in to take out your insurance and there isn't enough money in the bucket, your policy will lapse. Okay, so you got to keep that up. And remember that death benefit they're going in for, that keeps going up. So people in their 60s and 70s, they have a significant amount coming out of that bucket every month. They can't be taking that cash value down. They'll lose their insurance. That's, again, not on the test. Universal life. How do I get cash out of a whole life? I take out a loan. Okay. A loan is supposed to be repaid. If you don't repay it, they'll collect it when you die. Whatever you took out, they'll deduct it from the death benefit. But with a universal life, they allow you to take out a loan, or you can do something called a withdrawal. A withdrawal means I just take money out of the bucket and I don't owe it back. I still lower the bucket, okay? But I don't have interest to pay on it and I don't owe it back. And that's the only policy that allows me to take a withdrawal. If you want money out of a whole life, it's got to be a loan. Is that a big deal on the test? I don't think so.